Let's look further into strategy. What should you do with your portfolio from here? Joining us now is Joseph Amato from Neuberger Berman. Joe, great to have you back. So
Thanks, John.
I know you favor value over growth here, but do these results from some of these tech names make you question that at all?
Well, I think it's certainly been an interesting earnings season over the course of the last number of weeks, right? We've seen companies, whether they're in the producing goods or services, see some of the fundamental dynamics drive their business. So, you know, we see weakness on the goods side, we see strength on the services side. So to me, it's not so much about growth versus value, it's about quality. It's about companies that are able to protect their margins in the face of weakening fundamentals, right? When you went into this quarter, I think the consensus was roughly 2% revenue growth across the S&P 500, which with earnings down about 5 or 6%. So clearly margin pressure was the expectation broadly, and that's what we've seen. You know, for every strong performance by Microsoft or the Facebook numbers you were reporting on, or Meta just recently, versus some of the things like UPS or 3M that had tough reporting periods.
So tell me about fixed income and how retail investors, the folks at home, should think about that strategically. I know you say there's a preference for shorter duration and cash, but you can only do that for a little while. If you're still needing to build into the percentage allocation that you feel like you ought to have in fixed income, how should you do that in this environment?
Well, I think one of the benefits of having a relatively high short-term rates, whether it's a 2-year treasury yielding close to 4% or other short-term instruments that can give you decent yield, you're actually paid to wait to take risk. You know, one of the concerns we have is that earnings still need to come down over the course of the next few quarters. So in that kind of environment, if you can get paid a decent level of yield and then slowly put money to work, whether it be in longer-term duration fixed income, which also has decent yield, or putting money to work in the equity markets, you have that benefit. You know, if we were sitting here a year ago or 18 months ago, if you had money in cash, you were literally getting zero. So you weren't paid to wait. Here you're paid to wait to put money at risk.
How does the Fed factor into all of this? I guess what's your expectation in terms of not a hike next week, but whether we get a hike and a pause? And also, just as importantly, how real is the fiscal risk coming out of D.C. around this debt ceiling right now?
Sure. I think the expectation we have is that the Fed will increase rates next week. Not that they should. I think they should pause. I think the financial stability issues that we've been dealing with, you know, going back a month plus ago, and then more recently this week with some of the First Republic disclosures, I think tells me that the tightening of financial conditions that the Fed's been engineering over the course of the last year is in fact happening. And it, to me, you know, means they should pause. For all intents and purposes, essentially the rate hike cycle in our view is essentially over. So, you know, it's a time to start thinking about, you know, what is the impact in markets when the Fed stops raising rates, and do you start putting money to work again? In the context of fiscal risk, we think the debt ceiling is going to be a lot of drama around that. To me, there's only one way, and I think there's only one way this is going to end, which is the debt ceiling is going to be raised. There's only one way it can end. That doesn't mean there's going to be a lot of drama ahead of that. And we saw a lot of that back in 2011, the last time it was really quite a contentious issue. So I would be prepared for fixed income volatility. Again, another reason that putting money and keeping money in short duration fixed income right now in anticipation of some additional fixed income volatility makes sense.
All right. Joseph, thank you.